Hello and welcome back to Effortless Investor, the channel where we keep investing simple, realistic, and hopefully effortless. Before we dive in, I just want to say a massive thank you to those of you who subscribed on the last update video. Honestly, I'm blown away by the support. This channel is all about documenting a realistic investing journey, and it means a lot to know it's resonating with so many of you. If you're new here, the channel is all about keeping it real. No flashy cars, no private jets, and definitely no millionaire overnight nonsense. Just a regular person building an investment portfolio 1 month at a time. In today's video, I'll be sharing an update on my Trading 212 portfolio, which now sits at £1,400. I'll be walking you through how the stocks and ETFs have performed over June, and of course, I'll break down exactly what dividends I received this month. If you want to skip straight to the dividend breakdown, feel free to use the timestamps in the description. Alright, that's enough intro, let's get into it. Starting with an overall look at the portfolio for this month, you can see it has climbed nicely by 2.7%, which is the nice steady growth that I'm aiming for. Nothing too volatile this month, which makes a change from the prior few months. I'm moving ever closer to that next target of £1,500, which I'm hoping to hit by the end of July. Now let's take a look at the growth pie, because even dividend investors like a bit of capital appreciation on the side. This month, the growth pie is up 2.9%, which is again exactly what I'm looking for. As they say, slow and steady wins the race. You'll notice that it's looking a little different this month. That's because I've made a significant change for the month. It now consists of just 2 funds, VWRL making up now 70% and EQQQ taking the remaining 30%. The VUSA fund has been removed. And no, it's not because I suddenly fell out of love with the S&P 500. It's because there was a little bit too much overlap across all 3 funds. Basically, I was paying for the same companies multiple times, just in slightly different packaging. This was actually pointed out in the comments of the last update video, and I want to say a big thank you to the viewer who mentioned it. That was a great suggestion and exactly the kind of feedback I like to see on this channel, so again, thank you. Now before the change, the pie was split like this: VWRL at 40%, EQQQ at 30%, and VUSA at 30%. But consolidating has helped me simplify things and make the portfolio a bit more efficient and more in line with my goals. Less overlap, more clarity, and still plenty of global growth potential. Moving on to the individual performance of each fund, let's start with VWRL. As you can see, the fund is up almost 2% this month, and due to incorporation of the VUSA capital, I now hold 5.3 shares of the VWRL fund. There is no dividend for VWRL this month. That is coming in July, and I'm expecting that payout to be the biggest dividend I've received to date. So make sure you subscribe to the channel for next month's update for that. As for EQQQ, it is up a nice 4.4% this month, continuing its rebound and growth from the beginning of the year. Let's hope that continues. My total shares for this fund is currently sitting at 0.62 shares, moving ever closer to a full share, which I hope to hit in the next couple of months. I did get a dividend from EQQQ this month. Feel free to use the timestamps in the video description to skip to that section right now. If we move on from the growth to the income pie, we can see it's slightly up for the month at 1.4%, which is pretty decent growth for an income pie. JGGI and VHYL are both back in the green for this month. Let's hope that continues, as between them they make up 50% of this pie. Similarly to last month, we are seeing some solid growth from BAE Systems, British and American Tobacco, Legal and General, and National Grid. I had a total of 8 payouts from the assets in this portfolio this month, which I'll get to shortly. This included my first payout from JGGI, which was the second largest payout I've had to date. I'm going to continue to buy into this pie and increase my positions. The JP Morgan equity funds in this pie are still being reviewed. They are new funds, and I'm currently evaluating whether or not I keep all 3 of them going forward. So stay tuned for that in the coming months. Take a look now at the Moonshots. These are the stock picks that I think, or more accurately hope, will grow significantly in the next 3 to 5 years. As always, I'll start with Palantir, as it is the best performing asset in my portfolio. It's gone up another 10% in the last month, which is awesome. It's now approaching the point of how greedy do I want to be, or how confident am I in its long-term growth. The £180 is a lot for a small portfolio like mine, and I find myself wondering from time to time if I should sell and reinvest into my growth pie. For now, I'm going to hold, but it's a stock I am continuously thinking about. Up next is Nintendo. I did a video at the end of May about why I think Nintendo is worth buying. I'll pop a link to that in the top right of this video. Although I wasn't expecting any growth this month, we can see it's grown by a nice 15%. I'm hoping that once the sales for the Switch 2 start to factor in their earnings reports, we might see some more significant growth. We have Rigetti Computing, which is unfortunately down almost 16% for the month. This is a bit more of a long-term play and might take 5 years to see any significant growth, so I'm not too concerned about it for now. Moving on to Xiaomi. If you don't have any Xiaomi products, I suggest checking them out. Their cordless screwdriver is an awesome product and the only screwdriver most will need around the house. In terms of growth though, for this month, Xiaomi is up 18%. Hopefully the stock will continue to grow and push onto new all-time highs going forward. A bit of news this month on this stock. Essentially there was a reverse 1-to-8 stock split, meaning that the share price theoretically increased, but for every 8 shares I owned, I now own 1. I previously owned about 15 shares in total, but now own just 1.8 shares. The value is still the same, so in that respect, there is no difference. Whether or not a reverse stock split is a positive sign is up for debate. There are some examples of reverse stock splits being positive, specifically Amazon in 1999, Apple in 2000, and Netflix in 2004. However, these may be exceptions rather than the rule. In my opinion, it's not a good sign, and KULR is a stock I will continue to be monitoring. Just looking at the growth over last month, it's down 24%. Archer Aviation and Hims & Hers Health are still down, with Hims & Hers dropping about 28% last Monday, after Novo Nordisk seemingly ended their partnership with them. Its earnings are still strong, so it could be an opportunity to dollar cost average. I'm currently evaluating that potential proposition. Action. Finally, we have Fortress Biotech. It's a stock I've held since October last year, and although it is still down, I still think it has potential to grow considerably. I'll be interested to see the Q2 earnings report. It's another stock I'm continuing to monitor. That concludes this look through the Moonshots. Some good growth overall and some more research to do this month with others. Let's see what next month brings. JEIP kicked things off with a mighty 4p. Main followed with 2 payments, totaling 10p, steady and reliable, just like you'd hope a monthly dividend payer would be. Unilever came in next with 8p, a tidy sum for a stock that's basically in everyone's cupboard already. JEGP also delivered 8p. Not massive, but it all adds up. SMIF chipped in with 13p, joined by JEQP also at 13p. A matched pair of passive pennies. BAE Systems was on the manoeuvres this month, landing a small but welcome 9p. Legal & General brought in a very nice 46p, one of the bigger contributions in the portfolio. Then we have a newish face in the dividend section, EQQQ, handing over 24p. Not bad for a tech-heavy ETF that's usually more about growth than income. And finally, the star of the show this month, JGGI, dropping in a chunky 57p. My second highest dividend payout ever, definitely earning its place in this portfolio this month. Altogether, that adds up to £1.92 in dividends for June. Not enough to retire on just yet, but enough to remind me that this whole process is working. Slowly, steadily, month by month. And remember, these are real results from a small, realistic portfolio. No magic, no secret sauce, just a bit of consistency and patience. In summary, the portfolio continues to move in the right direction, both in terms of growth and dividends. If we compare the dividends from the first 6 months and the last 6 months, there's an increase of 101%. Whether or not that rate of increase continues in the next 6 months, only time will tell. The total unrealized profit for the portfolio is currently at 11.4%, which is up 1.4% from last month. So let's hope that keeps going. And that's it for this month's update. The portfolio is ticking along, the dividends are tickling in, and we're making slow, steady progress just the way I like it. If you enjoyed this video and want to keep following along with my investing journey, make sure to hit that like button and subscribe if you haven't already. It really helps the channel grow, and who knows, maybe next month we'll break that £2 dividend mark. Now, if you're looking for something else to watch, I've got a couple of recommendations that might be right up your alley. First up, if you're into dividend investing but also have a soft spot for gaming, check out my video on why I think Nintendo stock is worth buying. Spoiler alert, it's not just because I love Mario. And if you're just getting started with investing or know someone who is, take a look at the best stocks and ETFs for first-time investors. It's a beginner-friendly guide with no jargon and no nonsense, just good solid options to consider. Thanks again for watching, and I'll see you in the next one. Until then, keep it simple, keep it realistic, and of course, keep it effortless.